Hey, Jonah.
What's going on, man? How are you?
Doing good.
I'm gonna mute myself real quick while I shake up my protein drink.
All right, you do it. Good to meet you.
I just
I
got
got me.
back from the
I
gym,
got me some hot water. Enjoy it. Oh man, we have people joining already. Okay. What do you do at the gym? What's your go-to?
um, so I haven't been going. I mean, I was going 6, 7 nights a week. 2 hours a night. I was pretty hardcore, but now I find myself kind of stuck at my computer. When the market closes and I'm, on Twitter or stuck doing some stock research or updating something, and then before I know it, it's 7 o'clock, and I no longer have motivation to go to the gym. But I'm trying to force myself to go for maybe an hour and a half every night. Just something is better than nothing. But
Good for you. That's fantastic.
I'm a chest guy, so I'm all about the bench press.
All right.
What about you?
I'm a yoga. I do yoga. I do walks. I do that kind of stuff.
You're probably way more flexible than me then.
Well, I could feel the arthritis runs in the family. You know what I mean?
Yeah.
So it's like I have to do everything I can to fight it.
When I wake up in the morning, I have to walk around my bedroom for a few minutes just to kind of loosen up my my Achilles and my knees before I go down the stairs, just because I'm so stiff in the morning.
Yeah, all the stretching helps me out, but
Yeah,
I'm jealous if you can get to the gym that often. That's great to have that kind of discipline.
I'm probably 4 or 5 days a week now instead of 6 or 7.
Still 4 or 5 more days than me.
So we're let's see. I don't think Peru's in here yet.
I didn't. I have not seen him, but thanks for setting this up. Should be fun.
Yeah, definitely. So I figured, the numbers of questions that came into me through DM and email is pretty insane, especially since I wasn't soliciting questions. I figured we'd find enough things to talk about. We didn't need people to lead us into anything, but
yeah,
a lot of people are, I think, very curious to know our opinions on lots of different topics. So, maybe we do this once a month, but there's no way that we could get to all these questions tonight. Even if we did this every night for the next month, I don't think we get to all these questions.
Sure. Yeah, I saw GameStop had another day, huh? I'm sure we're gonna get questions about that.
Yeah. Oh, there's definitely a few that came in. I don't know what exactly happened. I saw it was up 100% during the day and then 100% after hours. Is that
no clue?
Portnoy say something to people? Elon?
It's entirely possible. I don't know. True story. I was an investor in GameStop for about 3 years, and then I sold out completely in December.
Wow.
So right before the run up.
I'm just wondering how many people got into GameStop at the beginning of the insanity, rode it all the way up to 400, and didn't sell any shares because they thought it was going to the moon. And then watched it come all the way back down to 40 or 50.
Hard to know. I see Puru. Hey, Puru.
Hi.
Oh, okay.
Morning, guys.
How are you?
Good to video chat with you, my friend.
Yeah, good to see you guys finally in person. Well,
yeah.
Online.
So before we kick off, so everyone knows this is being recorded. So if you have to jump off early or want to watch it again, I'll post the recording on Twitter as soon as it's available. And I believe as long as you're registered for the event, that an automatic email goes out to everybody with the recording. I think that's just kind of part of the Zoom webinar system. Before we get started, I'm just going to read off a very quick disclaimer. Everything said during tonight's webcast is intended for educational and informational purposes only. Everything said during tonight's webcast is not intended to be financial advice, investment advice, trading advice, tax advice, or any other kind of advice, marriage advice. I don't know what else we're going to say. Before making any investment decisions, please do your own research and due diligence or consult with a professional. None of the hosts during tonight's webcast are responsible for any investment or financial decisions you make in your own account. And then let me throw up, so Brian, I did create those questions. Let me see if I can post one. I've actually never done, oh, here we go, poll. Here we go. Can everyone see that?
I can't.
Oh, no, I have to launch it. There we go.
Oh, there you go. Yeah, I'd be curious to see what the results are here. We can't vote.
Can you guys see the tallies as well?
I can't see the tallies, but that's okay. I think once you hit done, then it'd be able to share.
Okay.
But how long have you guys been investing for?
Puru, you go first.
Well, I started in the late 90s. 1998 is when I first started investing professionally. I was 22 years old then.
And I graduated. Oh, sorry.
No, I said I started working as a trader in 1998. I used to trade Japanese commodity futures and Hang Seng Index futures here for a firm. So that was my foray or beginning in the investment world.
Wow.
22, 23 years ago.
And I got out of college in 2002, started working for Morgan Stanley, managed capital at the big brokerage firms, wealth management firms for about 10 years. And then I became an entrepreneur. And then in the past year or so, I've gotten back into the markets full time. And what about you, Brian?
I started buying and selling stocks terribly in about 2004. I made mistakes for several years, and I would say I got better at investing by 2008, and I really understood investing by 2011. So I've been buying and selling stocks for about 16 years. I would say I've been investing for about, about 12.
So you probably have your fair share of scars and wounds.
Oh, yeah.
I certainly do. Puru, what about you?
I've had my fair share, believe me not. Believe you me.
Otherwise, the lessons don't stick unless they really sting.
So based on the results, I assume everyone can see these on the screen. So 27% of people less than 2 years, 26% 3 to 5, 18% 6 to 10, 12% 11 to 15.
Wow.
And then about 17% over 16 years. So
awesome. People investing a long time.
I mean, we are going to keep this pretty casual, and maybe this becomes a monthly thing. I really didn't put much thought into it, other than yesterday the markets were going crazy. I think people were scared when they woke up. I mean, I woke up, turned on my computer, and I was down 19%. First thing in the morning or right when the markets opened. I didn't know that was even possible. I own 50 stocks. I mean, I am weighted towards my favorite positions, or at least my top 10 positions are about 55% of my portfolio. But I think half of my stocks were down double digits yesterday morning, and I think a quarter of them were down at least 15 or 20%. Now, that doesn't bother me, because I had some cash available, and I just know that if you're going to invest in growth stocks, you have to be willing to accept those sorts of days along the way. And I've been through these massive drawdowns, or these bloodbaths, as people like to call them. And very rarely, I mean, it did happen a couple of times last March, but very rarely are you down that much in the morning and then you actually close near the lows. I mean, you're typically going to see the big buyers come in and move the market higher. So I was happy to see that. It was still a bad day for me. I would think I was down 6 or 7%. But what do you guys do when you wake up and it is just everything on your screen is red? First thing in the morning, 6:30, 7 o'clock, whenever you look at your computer, how do you approach the day?
You want to go first?
Yeah, go ahead.
So I typically don't have my brokerage account open every day. To be perfectly honest with you, I work for the Motley Fool, and we are doing live stream stuff. So I typically structure my day mostly about whatever writing I have to do. I do live streams like this with them, and when that comes on, there's typically questions that we're getting about why is blank 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 stock up or down. If I own the stock or know the stock, I will often take a look, but when it comes to down days, I've seen my portfolio have plenty of down days, like the one that you're describing, and I'm sure I had a really bad day the other day. When I see things like that, it can be unnerving the first, dozen times that you go through that. But my personal investing style is to just buy really great companies and own them for really, really long periods of time, because I know that in the long term, whatever companies I buy, if I'm right about the company, the market will eventually realize their value. So I mostly pay attention to companies around earnings time. I look at earnings reports. I look at revenue growth. I look at margins. I look at trends. I listen to management. What are they guiding for? And I want to know, is the thesis for owning this stock on track? And I know that in the short term, anything could happen. Like I mean, one of my favorite stocks is Pinterest. I'll be roughly correct here, but Pinterest came public, I think, at like $30. It shot up to like $40. It again kind of slid downwards, and in March it hit like $10 per share. If you follow the company along the way, every single quarter they were reporting pretty good growth. And that $10, if you could get in anytime around any of that buying price, you've done fabulously, because last time I looked, Pinterest was like $75, $80. But to me, the thing I'm focused on is, what's Pinterest going to be worth in like 2025, 2030? If I'm right about the thesis on Pinterest, I think it's going to be a multi-$100 stock. So what happens tomorrow to it? What happens 3 weeks from now? What happens on, what day is today? What happens on February 24th, 2022, 1 year from today? I don't know. And I don't care. What I care about is, am I right to own Pinterest? If I am, I'll do fine in the long term. So I've just trained myself to, if I see red and it's a stock that I own and I like, I'm just like, all right, that's what happens.
How many stocks do you have in your portfolio right now?
I have about 80, okay. Between 80 and 90. That seems far less concentrated than it is. If you look at my top 20 holdings, that's probably about 70% of my capital. So my personal style is just add, and continue buying more of my winners. And my winners will gradually become a larger and larger portion of my portfolio. So if you look at my top 10 holdings, they're like all my biggest winners ever. So it's
right.
Like
I was going to ask you if they got that big because you added to them so many times, or just because it was performance.
Yep. It's all performance. And this is by the way, I'm so interested in speaking with you guys, because there's a bazillion different ways to invest. And I don't proclaim that my investing style is correct. I just think it's what works for me. I know that there's lots of people that do very well with far more active with their portfolios than I do. I know that you guys run much more concentrated portfolios than me, correct?
I was more concentrated last year than this year, but I mean, I have 50 names in my portfolio right now, but as I was alluding to earlier, the top 10 names represent over half of my portfolio.
Mm-hmm. Yeah.
My top position is 10% of my portfolio. So
that's pretty similar to me. I think my number one is like 8%.
What is your number one right now?
Mercado Libre or Tesla, depending on the day.
And those are stocks you're probably going to own for the next decade, right?
I'm very bullish on both for the very long term.
So how often do you typically add to your investment portfolio? Is money just coming in every week or every month, and then you spread it around?
Yeah, I contribute to my my account once a month, and if I see something that really piques my interest, I kind of buy it and add to it. If I don't, I've been building cash for a couple of months now. I mean, as you guys know, the market's just gone, and it is much more fun to be a buyer in February, March, and April than it was in December, November, and January. That doesn't mean I sell out or proclaim to know what's going to happen. I tweeted about this, but if you ask me, I thought the market was overvalued in 2017.
I mean, I think it's funny how many investors find it easier to buy on green days than it is on red days. I love buying on red days. Big bloody days I have no problem going in and picking off my favorite stocks when they're down 5, 10, 15, 20%. I will not buy stocks when they're up 10, 15, 20% on a day, or at least very rarely. If there's some news or catalyst that just came out and I think that, that could push the stock much higher, then maybe I'll add to it when it's up 10 or 15%. But, rarely am I adding on big green days. Now, Puru, what about you? How do you kind of approach those really big bloody down days, and how's your portfolio constructed right now? I mean, I know, but a lot of people probably don't know.
Well, I've got about 25, 26 companies in the portfolio right now, and that for me is already quite diversified. Normally I run like a more concentrated portfolio, with about 18 to 20 companies. The problem is, or if you can call it a problem, the problem is that there are so many exciting new listings coming onto the market almost every week. And I'm kind of sitting here, pulling my hair out, not whatever's left, pulling my hair out. And
you still have more hair than me and Brian.
I was going to say, I think you're in first place on this panel.
It is thinning. I just sit here, pulling my hair out and wondering, how do I get exposure to this exciting opportunity? And the problem is I love most of the companies, or in fact, all of the companies that are in my portfolio. So I'm thinking, geez, what do I do to actually, get some exposure to this particular business? So what I have been doing, I've been basically buying those on leverage. Now, I don't advocate or recommend leverage to anybody. It's obviously risky. You're playing with borrowed money, and if the stock goes up or down, you still have to repay the margin loan. But I've been buying some new listings with borrowed capital. So I'm leveraged by about 20%. So 100% of the equity is mine. And I've basically taken on 20% margin loan from the broker. So I can actually get into some of these companies. So, to answer your question, I've got about 25, 26 companies in my portfolio right now. And frankly, I'm not happy with so many of them in the portfolio because it's just harder for me to track. So, I'll see how it goes. Maybe when the QE ends and when the easy money is made, I may actually dump some of the more high beta speculative plays. But I think as long as the Fed is, easing and buying bonds worth $120 billion a month every month, and central banks all over the world are super easy and they're tackling this economic crisis, I would be very, very surprised to see a prolonged bear market. I think if you look at the past 10, 12 years history, since QE started in 2009 or 8 end, you will note that whenever QE was going on, stocks actually went up. And whenever QE ended, or when basically the Fed stopped expanding its balance sheet, or when the Fed started contracting its balance sheet, that's when we had trouble in risky assets. And stocks are risky assets. Cryptocurrency is a risky asset, so they do very well when you have, a wave of liquidity coming in, and then when the tide goes out, that's when, things get pretty hairy. So I'm going to stay fully invested and stay invested with leverage for as long as QE is going on. But I would probably get rid of some of the high beta speculative plays when the QE stops, because I think some of these names are going to come down 50, 60, 70% when that happens. Now, to answer your question as to how I deal with volatility, I use a hedging mechanism, as you guys know. So, when the broad market is in an uptrend, and the indicators are defined or described in my pinned tweet on my Twitter account, I don't do anything. I just ignore it like Brian does or you do. I just look at the ticker. I think, okay, people have woke up slightly manic depressive today. It's gone down. It'll come back up again. As long as the business is sound and the company's fundamentals are solid, I don't really care that much about the volatility, both on the way up or down. In fact, when stocks go up a lot very quickly, that's when I become more nervous than when stocks go down, because obviously if they've gone down a lot, that means my risk going forward is lower. And if a stock has doubled or tripled in a few weeks or months, that's when I get really nervous, because I know, this has become very, very frothy, and I generally take some off the table, or I may actually sell something. But when stocks go down, it doesn't bother me, because I know that, good businesses always come back. So if the stock market is in a downtrend, when my trend filter is in a downtrend, then I'm pretty much hedged anyway. I mean, it doesn't always work out, because sometimes the growth names get crushed on their own, or sometimes they fall a lot more than the market. But I tend to hedge the portfolio in any event, because that at least mitigates the downside. It reduces the downside. And again, it comes with years of training and practice. If you are new to this game and all you've seen is a QE-induced bull market, then you think this is normal. You don't realize this is not normal. This is a very, very abnormal market environment where everything is going up. Stocks have tripled, quadrupled, quintupled in 12 months. This doesn't normally happen in a stock market. All this is primarily due to the easy monetary policies of the central banks and the QE, which is going on at a global scale.
Can I ask you a question about that? One of my questions for you is, I know that you regularly tweet about QE, the Fed, that kind of stuff. Is that something, like, were you paying attention to that in 2018, or is that more something you're paying attention to now because of all the huge flooding that we've seen?
No, I've actually learned about this in 2009. When the markets collapsed, everything went down. I mean, I knew years in advance that the housing market in the US was a ginormous bubble. I knew it. I was writing about it in the 2006, 2007, warning everybody who could see that the housing market was going to implode and bring down the banks and stuff in the US and the Western world. What I didn't know was the timing. At that time, I wasn't aware of what caused the bubbles to pop, because bubbles can get bigger and bigger and bigger, and they can run for years. And a lot of the same value managers, they lose their reputations and their clients because they can see the bubbles, but they are way too early. So I basically spent several months, 1 year, scratching my head and wondering, why do bubbles end when they end? When does the music stop? And that basically brought me to, the yield curve inversion. And I looked back at data going back almost 100 years, and I realized that invariably most of the bull markets ended in the last 100 years after a period of significant monetary tightening by the Federal Reserve or the inversion of the yield curve. And that makes a lot of sense because, when you think about the stock market, what is the stock market? What is the business cycle? The business cycle is nothing more than the credit cycle, when you think about it logically. When credit is cheap and plentiful, when banks are willing to lend and money is easy to borrow, everybody, basically, most people use borrowed money. They borrow money, they buy property, they invest in businesses, they buy stocks. So when you have this cheap and plentiful credit, then basically you have a boom in economic activity and consequently a boom in financial assets such as stocks and real estate. And when the tide recedes, when you have a period of monetary tightening, when banks basically make it difficult for people to borrow and they're not willing to lend, and the interest rates are higher, so there is less of an incentive for speculators, for investors and so forth to take on loans, that's when the party ends, because then nobody is basically willing to buy more, so the market basically runs out of greater fools, and that's when you have the reverse of the implosion. So in my view, I've been doing this 20 years, and I'm absolutely convinced, backed by data, that the monetary cycle basically determines the economic cycle and the stock market cycle, and that's why I pay, the utmost attention to what the central banks are doing and what the monetary cycle is, whether we are in an upswing or a downswing, because the monetary cycle actually leads the economic cycle and the stock market cycle. And basically the monetary cycle is the horse, and the stock market and the economic cycle is basically the cart behind the horse. So the horse pulls these things in both in the upswing and also in the downswing. And that's what I pay attention to. And all the macro data and everything else are simply consequences of the monetary cycle. They are not the primary factor.
I think one thing that's interesting that we're probably going to see is it feels like the stock market is way ahead of the economy. Mm-hmm. And, just like multiples, a lot of valuations got ahead of the fundamentals. And now we're seeing, those stocks trade down or trade sideways, to allow the fundamentals to catch up to the valuation. And it feels like at some point that's what's going to happen in the markets. The markets will have to go sideways for a while or pull back to let the economy catch up.
For sure. I mean, it's always like this, the stock market discounts the future because people basically vote with their cash, and human emotions, both greed and fear, they've been the same for the last 100 years since the markets basically started. And, when people realize, things are going to get better, they try and, get ahead in the queue, ahead of everybody else to try and make money. And the market basically anticipates the economy. It's not the other way around. That's why, in my view, it's pointless to look at the lagging economic data, the macro data, because that actually lags both the monetary cycle as well as the stock market cycle. I mean, if you want to see what stocks are going to do in the future, you better pay attention to what the central banks are doing. And usually, not always, but usually the market is right. And, if stocks are going higher, and you can bet your bottom dollar that in the future, the news is going to become rosy. And when stocks basically start falling on good news, that is a sign that the best has been discounted, that the business cycle is about to topple over. And you will see, 3 months, 6 months down the road that, the news actually gets worse. So, I have learned that it makes a lot more sense to pay attention to the credit cycle and the price action itself as opposed to the lagging economic data.
Now, how much do you guys
Brian,
have?
how do you guys do it?
Brian, I'll let you go first.
So I am, a lot of that stuff is really hard for me to interpret, and I am a bottoms up focused investor. So what the thing I pay attention to is the business. Like, I don't try and forecast the market. I recognize that there are always huge things going on that control the near-term movement of the market. But for me, I'm like the thing I focus on is Pinterest. Like Pinterest, do I think 5 years from now this company will be worth more, and do I think it's worth buying today? That's where my focus is. And I have just I know that we don't talk about this much on Twitter, but to me, it's really important for investors to know themselves, one, and then two, set themselves up so that they can withstand whatever volatility is going to come their way. My personal strategy is I keep my personal finances ridiculously conservative. Just ridiculously conservative. I have no debt. I have a huge cash cushion. I have a wide savings rate, and that plus my just general mindset. I just know that I don't think that I can predict when downturns are coming, and I'll just be invested the entire way through, because I believe that over the long term, stocks will be higher, and that's where I want my capital. So I personally don't try and predict that, but I do have cash on the sidelines so that if that happened, I could be deploying it into my favorite names at better and better prices. But I do want to ask you, Puru. Actually, Jonah, you go ahead.
Yeah, I mean, I'm probably a little bit closer to Brian. My strategy last year was to bet on the pandemic winners, the companies that were seeing accelerated revenues from, the whole stay in home, e-commerce, digital payments, telehealth, internet infrastructure like cloud stocks. That's where I was overweighting my portfolio, and it worked out very well. So, the Squares, the Teledocs, the Cs. What else did I have in there? I mean, I did have some Tesla in there, which benefited me for most of the year, and Fiverr and CrowdStrike and Fastly and whatnot. But, as those companies outperformed last year, I was trimming, as they were, going up, 30, 40, 50% every couple months. I got nervous that we were going to get a big pullback. Valuations felt like they were getting stretched because it didn't seem like that revenue growth was going to be sustainable. So I was trimming those stocks throughout the year, and I still did very well last year. But, looking back, I actually trimmed some of them way too early. And then I dumped a lot of those stocks, or at least half of those stocks, before the end of the year, and started transitioning my portfolio into some smaller cap names that I felt, were due for some multiple expansion, or there were some catalysts coming up that the market wasn't paying attention to. So that's kind of been my focus the last 2 or 3 months now, is building out a portfolio of smaller cap companies, stocks with market caps under 10 billion, although I've been even more focused on under 5 billion, companies with revenue growth at least 30 or 40%, although most of them are 50, 60, 70%, and that's, sustainable for the next 2 or 3 years. Many of these stocks are in healthcare or medical devices or recent SPACs. I mean, there's still a ton of opportunity, I believe, in SPACs. Some of them, of course, are overhyped, and you have to wait for them to pull back a little bit and kind of settle into some, a more reasonable price range. But, a couple positions that I've started recently are SPACs that are still trading under $12 with 50 to 60% revenue growth for the next 2 or 3 years, in these massive markets with a ton of international expansion, possibilities. And I just don't think the big funds are paying attention to these companies. And I just think there's a lot of upside in them. So when I build out my portfolio, and like I said, it's about 55 names right now, although obviously weighted towards my favorites, I'm looking for stocks that I think can 5X over the next 5 years, which would be a 38% CAGR. And if that's my mindset, that I'm focused on the fundamentals and the underlying stories to the business, so I'm not worried so much about, macro events or interest rates or, the Fed's balance sheet or that sort of stuff. I mean, I know that stuff goes in cycles, and obviously if interest rates keep going up or QE ends, we could see a big drawdown in the markets, but I have cash flow coming in every month. And if that happens, I'll just keep adding to my current position. So, I mean, there'll be some turnover in my portfolio, and there are stocks that rallied over the last month or two, and I should have probably trimmed them or sold them and locked in those 50-60% profits, but I didn't because I was trying to think long term. And then those stocks pulled back 30-40% in the last couple of weeks, and now I'm kicking myself for not taking profit. So, so I came into the year telling myself, focus on the long term, don't overtrade your portfolio, don't micromanage your positions, because you're just going to create a lot of, capital gains for yourself. But then you watch some of these stocks give back those profits, and then you're kicking yourself. So like it's hard to just stick with one strategy because the markets move so quickly. Sometimes you have to be willing to adjust on the fly. So, that's what I've kind of learned in the last few days is sometimes when you can take a 50-60% profit in a couple of weeks, you're better off just doing it. And if the stock pulls back, then okay, get back into the name.
I think I've learned that we need to move to Hong Kong, where there are apparently no capital gains taxes.
That's why I live here.
Is that true? There's no capital gain taxes?
Zero capital gains tax. I trade even if I trade like a maniac, buy and sell 20 times a day, nobody asks me anything. I get basically a questionnaire from the Inland Revenue Department once a year in March. Can you please report any income? Do you have any income from salary? No. Do you have any rental income? No. Sign, bye-bye.
Is that short-term and long-term capital gains?
Yeah, there is no capital gains tax in Hong Kong. There is no inheritance tax in Hong Kong. So that's why I choose to live here.
Yes.
So what do the personal tax brackets look like? Are they really high?
No, they're very low. I think the maximum tax that people pay here on income is about 17 or 18%.
Hey, do you need a roommate?
Yeah.
You should move here, guys. It really is worth it. I mean, it's a beautiful city as well. I mean, it's one of the best cities in the world.
Mm-hmm.
And, we've got a fantastic country parks. It's quite hilly and green. And you've got beaches, you've got country parks. You've got a world-class city half an hour away from my home. It really is the best of both worlds. Of course, whatever happened in Hong Kong a year and a half ago was very unfortunate. But with the national security law now, the protests and stuff have totally died down, and peace has sort of been restored in the city. And obviously, a lot of people are concerned about the human rights and so forth. But unless you are shouting on the streets and calling for Hong Kong's independence, I mean, nobody really cares what people say or do. It's pretty much, business as usual, as long as you don't go and instigate sort of rioting and violence and so forth.
The problem for you, though, is you have to live like a vampire because you are, 13 hours ahead of us?
Yeah, I mean, in the winter times, it's 13, and in the summer times, it's 12 because of your change of clock, obviously, time change. But yeah, it's difficult. But, given a choice between staying up an hour late in the evening and paying 20-30% in capital gains tax, I'd rather get less sleep and pay zero tax, to be honest.
Now, where were you living before Hong Kong? Because you haven't been in Hong Kong your whole life, have you?
No, I was basically born in India.
Okay.
I basically grew up in India. And then I came to Hong Kong when I was 21 years old. And then I've been here ever since. I've obviously traveled a lot. I've spent time in many countries, but Hong Kong has been my home since 1998.
Now, I know most of your portfolio is U.S. companies or ADRs that trade on the U.S. markets, right?
Mm-hmm.
Is it still difficult to buy international stocks, that trade on non-U.S. exchanges?
No, not at all. I mean, I'm able to buy and sell stocks all over the world. It's just that I, have more confidence in the corporate governance in the US. I have been burned in the past in Chinese stocks, the small caps. I think a lot of people were burnt in 2010 when they had those reverse merger type scams. I was thinking, holy crap, these companies are so cheap and they've got these fantastic growth rates and they look unbelievable bargains. And I even interviewed the CFOs and CEOs of these companies on the phone. I called them up in China, talked to them, and I wrote massive amounts of notes because I was managing money for investors at that time for my firm. And a week, 2 weeks later, I had these headlines in the newspaper saying, oh, this so-and-so company is a scam, invest the stocks down 60%, and then a few weeks later, another one. So that was very, very embarrassing for me, and also a big sort of wake-up call that, you cannot just blindly trust accounting in this part of the world. I just feel more comfortable owning American businesses or, companies in Europe or Australia and so forth, or even Singapore, because Singapore, the corporate governance is a lot better, they say, than in China. But again, that's just a personal preference. I'm quite sort of conservative in my approach now. I don't want to, lose money. I mean, I'm retired now. I don't have any sort of income coming in, so I depend on my capital gains from my equity portfolio to fund my lifestyle and grow my capital. So, I just prefer to sort of make a little bit less, if that is the downside. But I'd rather own, shares in companies where I know the companies are well managed, and also, where you actually own the physical company. Because if you invest in some of these Chinese companies, you don't actually own the business. You own shares in a variable interest entity, or a VIE, which has a contractual agreement or an arrangement with the Chinese business, but that is not actually ownership of the actual company.
Brian, what about you? How do you think about investing in international companies? I know you said you have one of your biggest positions is Mercado Libre. That's a company out of Brazil, I believe. So what percentage of your...
I think their headquarters is in Argentina, but their largest sales market is in Brazil. But yeah, okay. similar. But they're listed on the... I'm pretty sure the NASDAQ. It's either the NASDAQ or the NISE. So they comply with all American accounting standards and everything like that. So I feel comfortable with those kind of companies. In the past, I have bought on like the OTC markets or something like that. And like Puru said, I owned a couple of Chinese companies in 2008 and 2010 that, how could this company be growing 60% per year and trading at three times earnings? Not sales, earnings. Yeah, exactly. Oh, it still goes down 60%. So yeah, like Peru, I had some issues with that, but to me, I'm happy to keep the vast majority of my money in American companies, because American companies themselves, a lot of them offer international exposure.
Right.
I mean, so many American companies get if not half of their sales. They're on a trajectory to get more than half of their sales from international markets. So you can benefit from growth in international markets with American accounting. But I do not think about personally, I want 10% of my capital in China companies, 15% in European. I want 100% of my capital in awesome companies and 0% in terrible ones.
So what do you guys look for in terms of starting a new position in a company? What are some of the criteria that would get you to do that?
Brian, do you want to go first?
Sure.
No, go ahead.
Oh, okay. I thought you said you wanted me to go first. Sure. So the way that my investing strategy, my investing style is, I've developed a detailed checklist for myself that's been built up over the years through trial and error, and asking myself, what do I want in a company that is really appealing to me, and what do I not want in companies that are really unappealing to me? Like Puru said before, we are drinking from a fire hose of ideas, and there are more SPACs coming online. There are more IPOs coming online. It's like you are just thrown so many ideas at you, and if you read through an investor presentation and that management team does its job, you're excited. Like every single time, you're like,
they all look good.
This is it. This is the next one, right? So, and I, being part of the Motley Fool, we get dozens of recommendations thrown at us by very, very smart people that do wonderful jobs with writing up. But even prior to me working at there, I had more ideas than I did capital. And I said, well, I have to come up with some system to kind of vet these companies according to criteria that matters to me, because I was keeping all this stuff in my head before. I would be like, well, I like this company's culture and its market opportunity, but I don't like that it has customer concentration. And I like this company's margins, but this other one has a stronger moat. So I created a checklist that has a 0 to 100 point system, and you can give me any company And I start top to bottom, and I ask things like, what's the gross margin? Does it have earnings? Does it have free cash flow? What's the balance sheet? How wide do I think the moat is? Does it have optionality? Is revenue recurring? Is there ability to raise prices, et cetera, et cetera, et cetera? And I rank all of that criteria. And at the end, I subtract all of the things that I don't want an investment. I deduct points for really high stock-based compensation. I deduct points for customer concentration. I deduct points for if the stock has been a loser on the market. I actually want to invest in companies that have beaten the market already. That's a major part of my investing strategy. And after all that's done, it spits out a number. And that to me is like the business quality number, according to what I consider to be a quality business. From there, I do some very loose valuation work, like very, very loose. And in general, the bigger the opportunity, or the more I think a company can grow, the much more loose I am with valuation. If I think a company could be a 10-bagger in 5 or 10 years, I buy it. Right. I don't care what the price to sales rate. I don't care what the price to earnings ratio. I'm buying it. Like period. If it was a company like Apple today that I think is going to eke out maybe single-digit sales growth from here on out, I would be extremely price sensitive with the valuation, because the upside there is so much more limited. Whenever I'm deploying capital, it's the best combination that I see at any given time of business quality times valuation times potential. And whatever is like the number one choice for like all those three things combined is what I buy.
Perfect.
I've seen some of the things you put out with the checklist for all the stocks, and it's really good stuff, Brian. I really enjoy those.
Thanks.
What about you, Puru? What are a couple of the most recent positions you've started, and what gave you the conviction to get in those names?
Well, I've recently just invested in this pullback. I've basically bought yesterday, or not today actually. I've added to 3 companies. One is Origin Materials, AACQ. I've also invested in Black Sky, which is the geospatial data analytics business.
Me too. Yep.
Yeah, SFTW, I think the ticker.
Yep.
And then I've also invested in Carlox, which is LOTZ, which is the consignment model marketplace for used cars. And all these 3 companies have recently come onto the market, and they have some fantastic growth projections, and they operate in very large addressable markets. So the market is huge, and the growth estimates look pretty compelling. And also the valuations aren't too stretched, according to my view. I think if the companies execute, these could be 3 or 4x in 4 or 5 years. I look at exciting industries. And one thing I've learned, doing this for 20 years, is that when it comes to investing, the future is all that matters. The past is irrelevant. If you buy a business based on the incredible history of the company over the past 50 years, and you ignore what the company is going to do 10 years from now, you are making a huge mistake, in my view. If you look at companies like Procter & Gamble, Coca-Cola, Pepsi, Philip Morris, and all these companies, I mean, they've had their time in the day, in the sun. So, they've already done so well for so long. They are so big already. And the problem is that their products are actually falling out of favor with customers. So if you basically buy a business based on its unbelievable track record, and you ignore what the company is going to do in the future and what it is doing now, that to me is a huge mistake. I think you have to go for those industries and those businesses, which, like Brian said, will be significantly larger 5, 10, 15 years from now, because that is your margin of safety. If you try and go into a company which is basically disrupted, it is vulnerable, it is weak, it is being attacked, it is struggling to barely grow its revenue and keep its customers. And no matter how cheap that business is, ultimately at some point the business reality will catch up. You cannot avoid business reality as an investor. As an investor, your return over long periods of time is going to be similar to the return from the underlying business. What is the return generated by the underlying business, and how much the business can compound. And I basically put out a chart which was actually I think created by Luca Partners. I think Richard Chu, who's actually active on Twitter, he's joined them recently, and they had a fantastic table showing growth rates of certain companies So if you have a company growing at say 20% over the next 10 years, 30%, 10%, and even if you account for significant margin compression, or sorry, multiple compression over that period of time, say a 30% compounder over the next 10 years, even if its valuation compresses by sort of 75% over the 10-year period, you would still make a 15% CAGR over the next 10 years from the stock. That is still a lot better than the overall market's historic CAGR, despite a 75% contraction. So from my point of view, I don't want to, own the nasty, smelly, marked down merchandise. I want to own the most shiny business, the great business with the greatest prospects, which is basically, not struggling at all. Companies which are thriving, and I don't mind paying up for them as long as I'm not paying, silly bugger valuations.
Peru is definitely not a value trap guy.
No,
I'm not either. I mean, I'm always willing to pay a premium for the best companies, the fastest growers, operating in the largest markets. Some of my top positions, which I think most people that follow me knows, are, DermTech, which has created this genomic smart patch for early skin cancer detection. Now they're starting to get full coverage from the insurance companies. So that's a nice catalyst going forward. Transmedics, which has created these organ care systems to transport organs such as lungs, heart, liver, from one patient to the next. Right now, those organs are transported in ice coolers. So obviously what Transmedics is doing is such a better solution. And if they can get FDA approval on heart, OCS heart, that's another catalyst. So I'm looking for these companies that, like I said earlier, they're kind of off the radar. The big Wall Street firms are not paying attention to them. There's very little analysts covering them. And that, there's some upcoming catalyst in the next, couple months that could push the stock higher as you start to get, more analysts coming in, issuing coverage, increasing price targets, and then that leads to multiple expansion. Mohawk is another one. So Mohawk, the consumer products company that has this AI-powered engine. They work with Amazon and Walmart to identify trends and opportunities, and then they develop products to push through those categories on Amazon and Walmart and in their own Shopify stores. When I found Mohawk back in December, they were projected to grow revenues at 50-60% for the next couple of years, yet the stock was trading at less than 2 times sales. It was insane. And over the last couple of months, you've seen that multiple expand from 2 times sales to now 4 times sales. And I think over the next year or so, you could see that multiple expand to 5 or 6 times sales, as they do more creative M&A deals. So, I think there's a lot of companies out there like that, where I'm still finding opportunities in the small mid-cap space. And I can get excited about those companies. I can get really, really passionate about owning those types of companies, not just with hyper growth, but with a really unique story, business model, some catalyst or whatnot, versus I can't get excited about Facebook, right? I mean, Amazon, those types of companies, they just kind of put me to sleep. And I get it if you are if you're a more conservative investor or you're not looking for hyper growth anymore, you can go to sleep at night and sleep well, knowing that you have a portfolio of these very stable, low double-digit growing companies. And even Facebook and Amazon are growing at 25-30%, which is pretty incredible considering the size of those businesses now. To do $200 billion a year in revenue and still grow at 25-30% is almost mind-boggling. And the size of their balance sheets, their war chest of cash. I would argue that, Amazon is probably undervalued at 1.6 trillion and Facebook is probably undervalued at 800 billion. But it just takes so much capital to move those stock prices higher. I just think, once again, there's more opportunity in the smaller names that, should be these 5, 10, 20 baggers over the next 5 and 10 years. And if they do, I'll continue to own them, as long as the fundamentals don't break down or something doesn't go wrong in the story. So along those lines, what gets you guys to sell a stock?
For me personally, I sell for 3 reasons mainly. The first one is if I need cash for a new exciting opportunity, if a new exciting business, with incredible growth prospects is suddenly available in the public markets, and I need cash because I don't have any cash flow coming in. I don't have a job.
Right.
So I need to raise capital from my portfolio. So that usually leads me to sell one of my sort of older, more mature companies. And by mature, I mean, a company growing at 20-25% a year would be the one knocked out to buy, raise cash for the new opportunity. The other time I would sell is, if a stock has a massive, incredible run up, and I don't do this very often, only occasionally when a stock triples or quadruples in 2 months, like I did with Palantir recently. I bought in at $10 or $11. It went up to almost 40 in 2 months, and I thought this is insane. So I basically sold everything, booked my gains, and waited for a pullback. And I think when it dropped down to the sort of low 30s, 32 or 33, after a 30% drawdown, I reinvested. But I don't do this very often because stocks don't usually triple or quadruple in 2 months very often. So, that's the second
Except in 2020.
Except and the other time I sell is when, if the company does something unexpected, something is disappointing, if the operating results are weak, or if the customers are not coming in, or the order book has dried up, or the management misbehaves, or if the management does something really stupid, or, there are sort of hints of corporate governance issues, or if the credibility of the management is under the question, then I definitely get out. I don't hang around. I don't have any loyalty with any of the companies in my portfolio. I mean, I treat them as tools to make money. My only loyalty lies with my own portfolio or my capital. I don't care. I know a lot of people on Twitter and generally, in life, as investors, they say that, never sell. This company is a keeper. I will never sell this. I personally have, reservations about that approach, because how can you say you will never sell a company? If a company which is doing wonderfully today stops growing 10 years in the future and is basically dead money, it just becomes a value trap. It grows at 2% a year and pays a 6% dividend on borrowed money. And there are so many other exciting opportunities. Would you still own that company? I wouldn't. My goal is to maximize my portfolio CAGR. I'm interested in the highest possible return on my portfolio as possible. And I don't really mind the beta or the volatility. If it goes up around 20% or 30% in the process, and if I can achieve a very high annualized return on my capital, that's all I care about. How I get there is irrelevant. The second.
Well, and with no capital gains taxes in Hong Kong, it allows you to turn over your portfolio more frequently as opportunities arise. I mean, I would say that I would have been more aggressive in trimming this year if I was living in Hong Kong. There's a couple stocks, Matterport, which I got into a couple weeks ago at 14 or 15 as soon as the news came out, and then it rallied up to 24 or 25. And I was in that dilemma where I still like this company long term. I like the size of the market is going to grow. They're clearly going to be this leader in 3D spatial technology for real estate assets. But the stock got ahead of itself, and that's where I was kind of had that conundrum. Do I sell now, take my 50, 60, 70% short-term gains, and then hope the stock pulls back, or do I just let the stock do what it's going to do? If it pulls back, then I'll add to it. And I picked the latter. And, sort of unfortunately, it did pull back. And I think today I added in the $17 or $18 range. So I'm sort of glad it got to pull back because I got to add to it. But I'm also disappointed in myself for not trimming it or selling it in the mid-20s. And that's, so that's my dilemma. And I know, Brian, you're definitely more long-term focused. So, I mean, you would have not had any thought of selling in the mid-20s, right?
For which stock? Sorry, I wasn't listening to the stock you're talking about.
Yeah, it's well, I mean, in this case, I'm talking about Matterport.
Matterport? Yeah, I don't know that one, but I know that you guys are into it. So I'll have to check it out.
Yeah. And now's a good entry point. It's back down in the 17s. So
is that GVHI?
Yeah, GHVI.
GHVI.
It's a great business. I mean, I've seen their technology being used by real estate agents in the UK, in Hong Kong, in many other countries. I think they are in 130 countries, if I recall correctly. So this is now becoming the de facto software used by agents to showcase properties online. So where people can just go in go into the Matterport image, 3D image. You can rotate it, spin it up or down, left or right. You can actually virtually enter every room. You can actually measure the dimensions of any sort of area, whether it's a room or a cupboard or kitchen or whatever. It's pretty incredible technology. And I think this will become the de facto leader, as Jonah said, in this industry.
And one of the things I really like about that particular SPAC is that the sponsors are all big real estate owners themselves. So they have the assets and the properties to deploy, the Matterport technology, which is always nice to see. I forget what, in terms of, okay, so obviously none of us can be experts in every sector, every industry. So what do you do when, you think a company looks interesting on the surface, but you don't really understand the industry or sector that well? Will you just stay away from it completely, or will you try to, get to a point where you do understand the sector or industry? So for instance, two that I'm thinking about myself, one is 3D printing, and then the second is batteries, EV batteries, hydrogen technology, that sort of stuff. I don't know anything about any of that stuff. And I mean, I think they're exciting industries that, that long-term trends that I feel like I should be part of, but I just don't even know where to begin. And that part can be a little intimidating. So how do you guys approach that stuff?
If there's an industry that I know that I don't understand, it's biotech. So for me, biotech is just in my way too hard pile. So people pitch me biotech companies all the time, and it's just like, I know enough to know that I don't know enough. Like I have it's so binary.
Yes. Biotech is so binary, especially when they don't have any FDA approvals and they're going through trials, and you could get to phase 2 when the whole thing blows up on you and you're down 70%.
Yes, totally. So when it comes to things like that, I know that's not for me. I do understand devices much better. I worked in the medical device industry myself for 10 years, so that I can do. But to your question, Jonah, about company comes along, how do you judge them? My general model with that is I will read through annual report, I'll read through presentations, I will understand like the gist, and then I will say, all right, prove it. This is what you're saying. Prove it to me with revenue. If a company says this is what we're going to do, and then they have the revenue growth to prove it, I'll say, I believe you. That's to me how they prove it. A story is great on a stock, but a story with no revenue growth is just a story. But if the management team says, this is what we're going to do, this is our market opportunity, these are the reasons we're going to win, and then they put up revenue growth quarter after quarter after quarter, year after year after year, and it's accelerating, I say, all right, I believe you.
Right. And that's sort of what I'm dealing with right now. So I knew that I wanted some ag tech exposure. So I looked at a few companies, and the one that looked the most interesting to me, and I had a few other people mention it, was a company called App Harvest. And they're basically doing indoor vertical farming. And when you first think about it, you're thinking, why the hell would anyone grow anything inside when you can just go outside and grow it in the dirt for free? But then you start to read through the numbers and you realize it's more efficient to grow inside, where you can control the temperature. You don't have to deal with weather, right? I mean, you can grow indoors 365 days a year. You don't have to, use pesticides to keep the insects away. So it's just a way more efficient. I think that the crop yield, as they say, is something like 25 or 30 times higher than it is growing outdoors. So that was an industry that I knew nothing about, but the more that I dig into it, the more that I love it. And so it took a little while for me to become familiar with it and get comfortable with it. And the problem was, when I first heard about App Harvest, I think it was a $20 stock. And by the time I got comfortable with it, it was a $35 stock. So that's the problem. Sometimes the more time you take to get comfortable with these stocks, you suddenly missed your chance, to get in at a great price. But, back to, if you're going to own this stock for the next 3, 4, 5 years, and you believe in the story, then it's better to overpay in the short term and just, eventually let the fundamentals catch up to that valuation. And that's kind of how I look at some of these stocks as well.
Yeah. I mean, when it comes to sectors and industries, I on purpose now avoid certain industries. Biotechnology is one, healthcare is another one because of regulation. I also stay away from commodities. now because they are boom and bust, extremely cyclical. You can do very well if you can time the cycles perfectly, but it's a very hard game because these companies, they actually sell products where they have absolutely no control over the price of the product that they sell. You know, they are not price setters, they're price takers. And that's a very tough business to be in. The miners and so forth, they all fall in that category. The industrials also, by and large, they fall in this category. So, you know, if I find an exciting business in an industry which I have absolutely no clue about, I just pass. I just ignore it because I don't want to own something which I don't understand, because that basically, you know, will never give me conviction, and I will never be, you know, have the strong stomach to go through massive drawdowns. I mean, the industries that I do know fairly well, I mean, they are pretty hard as it is to keep up. So I don't have to be a jack of all trades. I would rather just specialize in some areas where I do know, I feel I know enough to actually risk my capital. And
is there a sector right now that you're overly bullish on, or
well,
newly bullish on?
I still think, you know, e-commerce is going to do very well over the next 10 years. I think software is going to do incredibly well over the next 10 years. These markets are enormous. I also think fintech payments are going to do incredibly well over the next 10 years. Streaming, you know, whether it's SVOD, AVOD, video streaming, or game streaming, gaming is going to do very well over the next 10 years. Anything to do with green energy, new energy, clean energy, is likely to do pretty well, you know, over the next 10 years, because if you see what's going to happen over the next 10, 15 years, a lot of these ICE cars, the internal combustion engine vehicles, are going to basically be removed from the roads.
Oh yeah,
they will be replaced with EVs. So I think that is a big opportunity.
I think in the US, there's at least a few states that have basically outlawed combustible engines after 2030, I believe, new sales. So I think California, maybe Jersey, and probably a few others. So, I mean, these states are going to essentially force the entire industry to go EV, whether they like it or not.
Yeah, and also not just EVs, you know, there are some other exciting opportunities also. You know, Origin Materials, for example, has come up with a carbon negative material. So, you know, their material is actually used in the production of plastics and packaging and so forth. And Danone and Nestle have signed up, and they are shareholders of Origin Materials. And this company claims to actually have developed a material which is not only going to be carbon neutral, but carbon negative. So, you know, these are some of the areas I think which are going to do quite well. And this company was actually brought to my attention by a very smart investor, hedge fund manager based in New York. I'm not going to name his name because of privacy, but he used to work for a big multi-billion-dollar hedge fund before he's branched off on his own. And he sent me a WhatsApp message kindly a few days ago, you know, said, hey, look at this one. And he also put Black Sky on my radar, and I did some due diligence and I read about those companies. And they were pretty incredible companies. So I think, you know, you have to look ahead. That's all I can say, really. You know, you have to focus on where the world is heading towards, not where it has been. And if you can identify certain industries or certain areas which are going to grow like crazy and which are going to become obvious 10 years from now, and if you can identify the leading businesses in those sectors, and if you can, you know, have the fortitude and the confidence to just own those shares and ignore the volatility and ignore the noise, I think you are going to do incredibly well. And, you know, a lot of people said to me in the past and now also, oh, but your portfolio is so risky. And, you know, one day you're going to lose your shirt. When the crash happened in March, my stocks actually fell less than the market.
Isn't that crazy?
Isn't that crazy?
Yeah.
And people said, I'm the crazy one, you know.
I know.
And the crazy thing is, you know, and I'm not saying this to sort of boast or gloat or anything like that, but, you know, I've started managing this high growth portfolio for 4.5 years now since I retired. And my portfolio has been become a 7 or an 8 bagger in 4.5 years. So my KGAR is over 60%. So, you know, even though my portfolio is more volatile than the market, I would rather take a 60% KGAR than a 4 or 5% or 7 or 8% KGAR from, you know, a safe company or an index. So as I said, for me, my goal is to maximize my long-term growth. And I'm sure that my compounded annual growth rate is going to come down over time. It has to. Nobody can compound at 60% a year. But even if I end up with a 20-25% CAGR over a 20-25 year period, I would be delighted. It's much better than earning 8 or 9% from an index.
I think, was it Wayne Gretzky that said, I skate to where the puck is going, not where the puck has been, something like that. And I think that's true for investing. I think you do have to try to think about the trends, the themes. And, I've been telling people when I host some webinars, I would rather be early than late. So get in DermTech early, get in Transmedics early, get in Mohawk early, get in Upstart early. That's fine. I don't mind being patient in these stocks, because if I'm correct and my due diligence was right and my thesis is right, then eventually everyone else will figure it out and come piling in, after I'm already in the name. So I think that's one thing, if we take anything from these last few days in the markets and the volatility, it's know your stocks, have the conviction, have the patience, don't overreact, don't panic. When the market was, when my stocks were down 20% a couple of days ago, I don't know who the hell was selling down 20%, but it wasn't me. I mean, I don't know if that's just the algo machines going crazy. I'd like to think retail investors weren't in there selling, but I think if you don't have a lot of experience and you haven't been through a lot of, bloodbath days or big pullbacks in the markets, I think you do panic. You wake up and you're like, oh my God, if I don't sell right now, this stock's going to be 40% lower next week. So I think you get a lot of panic selling from inexperienced investors, and then they're kicking themselves as it bounces back 10 minutes later.
I mean, my 10-year-old panicked. He asked me, my boy, he said, Dad, can you please pause the screen? That's not how it works.
Did it work?
No, that's not how it works.
Just turn it off.
Yeah.
This isn't a video game, son. You can't pause it.
So one of the last questions, because this is one that we obviously get a lot, I'm sure we all do on Twitter. In terms of crypto, I'm not a crypto guy. Do you guys have any thoughts on crypto? Do you own it? I mean, just for me personally, I'm not in it. I feel like I missed it, and I'd almost feel silly buying it now at, I'm talking Bitcoin at 50,000 or whatever it is. I prefer personally, and this is just my opinion, I prefer to invest in companies that have products, fundamentals, employees, margins, metrics, and all the other stuff where I can try to determine a value, a fair valuation now and where that stock might go over the next 4 or 5 years. With crypto and Bitcoin, I just have no idea. I think they go higher, but if they do, it's more hype and supply and demand than actual fundamentals.
I mean, I'm with you. I think crypto is a risk asset. It is a super high beta risk asset, which is totally dependent on liquidity. It is not a safe haven. I will get criticized for saying this again, but it is not a safe haven. If you look at what crypto has done over the last 2 or 3 days when we've had this stock market pullback, that should give you a fairly good idea of the correlation between stocks, growth stocks, and crypto. Crypto went from 58,000 Bitcoin to 48,000 when the stock market had a bit of a wobble. And when the stock market does well, Bitcoin does well. When the liquidity dries up, Bitcoin goes down 50, 60, 70%, 80% in some cases. So, if it is speculative money, if it's money that you don't care about, if it's 2 or 3% or 1 or 2 or 3, 4, 5% of your portfolio, depending on how much you want to, play the lotto and go ahead and, play the game. But, it is totally dependent upon sentiment. It is not dependent on any sort of fundamentals of revenue, profits, cash flows, and so forth. It cannot be valued. Same with gold and silver. They are unproductive assets. They are non-productive assets. They are basically an alternative to fiat currency, and it just shows how bad things have become in the real world when people are willing to part with their legal tender and buy software on the internet and bits on the internet and bid up the price and all celebrate. It just shows how dire and desperate things have become as far as central bank credibility is concerned. But if it is a small allocation of your portfolio, and if you're doing it with your eyes open, and if it is highly speculative and volatile and risky and it can go up 50% in a week, and it can even go down 50% in 1 week, then by all means go ahead and play the game. But it's not for me. I will not invest in Bitcoin. I will, the same way I will not invest in gold and silver either. These days, I invest in productive assets, and it works for me. And I would rather own a piece of a business as opposed to a piece of metal or software. But that's just me. Everybody's different, and everybody has to decide for themselves.
I feel the same way. Brian, any thoughts?
Exact same thing. Capital is limited. I have no ability to say why Bitcoin went from 1 penny to 50,000 pennies. So could it go to $1 trillion? Sure. Could it go to 1 penny? Sure. Like Puru said, I see nothing wrong with devoting a small portion of your portfolio to it. I also don't own gold. I don't own silver. I don't own timber. I don't own bonds. I don't own a lot of things. I understand stocks. That's where I want my capital for the long-term period. But if somebody wants to put a small portion of their portfolio in it because they believe in it, I say go for it. But for me personally, I can't see myself ever owning Bitcoin, and I don't own any today.
I agree. I think it's another risk asset that you can use to diversify your holdings. And if you're willing to own it for the long term and deal with the volatility, then by all means, I got no problem with it. And I do think, I think large companies, Square, PayPal, perhaps Visa, MasterCard, and others will be forced to continue buying Bitcoin, to have it on their balance sheet, to be able to complete transactions with customers. But a lot of that's over my head. I mean, there's a lot of markets out there I don't understand, so I'm better off just staying away.
Yeah, 100%. I mean, will I buy Bitcoin? No. Even if it goes to 100,000 or 1 million, I'm interested in it because I know if it goes to 1 million, it can come back down to $1,000 also. There is nothing stopping it from moving around because there are no fundamentals as far as profits, revenues, cash flows, etc. are concerned. And it is pretty much a confidence game. Same with gold and silver. Over time, these scarce assets are going to do better than cash. There is a long-term chart which was published by Jeremy Siegel in his book, Stocks for the Long Run, where he showed the performance of the various asset classes going back 200 years. And he showed, how a dollar invested in all these different asset classes would have grown over the past 200 years. And the results were mind-boggling. A dollar invested in equities grew to over $1 million over a 200 period. And basically cash lost over 90% of its value, which is why I understand, the allure of owning some Bitcoin and gold and silver because cash is being debased. But if you look at, what bonds did and fixed income did, they were very, very, very low compared to what stocks did. And same with gold. Gold also didn't do very much at all in comparison to stocks. So, these days, and after having looked at 200 years of history, I would rather own, invest the entire capital at my disposal in productive assets as opposed to non-productive assets. And I see what you're saying, Jonah, with the diversification thing, but I don't even think Bitcoin offers that much diversification from stocks because it moves in tandem with stocks. It's just like owning a super high beta stock in your portfolio. Because if Bitcoin basically went up when stocks went down, I would say, yes, that is a portfolio diversifier. But if Bitcoin goes up and down with stocks, just basically goes up or down a lot more, that is not really diversification. All you're doing is you're just speculating on the beta of equities or liquidity. And I think the chart that I'm referring to is behind Brian.
Oh, he just pulled it up.
and that $1 to $1 million is in real terms too. That's inflation adjusted. Yeah.
Exactly.
The nominal number was way higher, but yeah, I'm
exactly.
right,
So you
I'm
can
right
see,
there with you.
You can see the performance of all these asset classes over a 200-year period. And that's why, I prefer to own stock as opposed to any other asset.
So I was talking to my friend today, and he's a new investor. He's in his 30s, but he just got married and they bought a house, and they're sitting down as a couple trying to figure out how do they start investing for the long term to build wealth. And when he looks at what the markets have done over the last year and a half, or when I tell him how I've done, and then I tell him what the historical returns are, he doesn't believe me. he doesn't believe that stocks have only averaged about 10% a year for the last 50 years. So what do we do? How do we convince investors that, that the historical norms, that right now we are so far beyond that we have to, start to temper down our expectations going forward? Is there anything we can say, or do we just have to wait for the markets to show us?
Brian, do you want to go first? My laptop charger battery is dying. I need to get my charger.
Sure, no problem. I actually have to run in a few minutes, but I'll say, yeah, that if you don't believe it, I mean, eventually the markets will crash, will decline again, and that's when you'll believe it. There are some things about investing that I had to learn the hard way. Period. It's the only way that I was going to learn them was the hard way. And if you believe, if you started investing in March, or if that's when you started paying attention to the market, of course you think that more stocks go up 8% a month every month, and that's how the market works. Of course, that's your sphere that you've been paying attention to it before. And when you see a chart like this and it says 6% or 7% annually, and that's after inflation, you're like, that makes no sense. That's a bad month. Right. That's not a good year. That's right. A bad month. So yeah, that's something that people will have to just learn the hard way for themselves if they don't believe it.
And I would recommend that people, I know a lot of people want to be on margin right now because it's a nice way to amplify your portfolio and maximize your returns. But just keep in mind, I mean, when we do get a drawdown, and I'm sure we will, I do think this year is, we have not seen the end of the volatility. I think we're going to have more days like yesterday. I still think overall it'll be a positive year. Maybe we eke out a, high single digit, low double digit return. I think the best stock pickers will, do 3, 4, 5 times better than that if they're really good at stock picking. But, just know what you own and be able to manage your risk. I'm not saying you have to hedge your portfolio because I don't think a lot of people hedge. I don't really hedge. But just know that, I mean, if you lose 20% in your portfolio, you need 25% to get back to even. So the bigger the drawdown, the harder it is to get back to where you were. So, the goal, in terms of, long-term capital appreciation or building wealth, I mean, the real goal should be not necessarily maximizing the upside, but minimizing the downside.
100%. I mean, this is exactly why I hedge. Because it's simple maths. If you look at how the drawdowns work, if the equity portfolio goes down, or any portfolio goes down 50%, you need 100% return to get back to break even. Right. If 100 becomes 50, 50 doesn't go back to 100 if it goes up by 50%, that will take you to 75. It becomes 100 when it doubles. And it's not easy to double anything, right? So, the name of this game for me is to maximize my gains when the going is good, and then protect my capital when things get rocky, because one of the reasons why hedging does work over the long run, and it has basically outperformed buy and hold by a large margin, and I'm not saying this based on my opinion, I have actually back tested this on a quant software over several months. Hedging works because it reduces your drawdown. Okay, so if the market goes down 50%, and if I go down 15 or 20%, it's a lot easier for me to get back to my break even than it is for somebody who's gone down 50%. And that's why my entire portfolio almost quadrupled last year, is because when I was hedged in the March crash, my drawdown was, I think, maybe 15, 17%, where everything else went down 50. And then I basically locked in my hedging profits near the lows. My signals came to remove the hedges in late March, and I suddenly had all this cash. And I thought, oh, I've got all this cash, what do I do? So I basically reinvested all that cash in all these companies that I had. I bought more shares aggressively near the lows. And suddenly my capital was a lot larger. And that's why when the bounce or the rebound came, my entire portfolio quadrupled in a year. And that's not because I'm a genius, that's because I just simply hedged and protected the downside. And I cannot emphasize this enough. If you look after the downside in this business, the upside takes care of itself. And if you look at any investor or trader who has basically displayed longevity in this business, they will all say to you that their focus is on protecting the downside. They don't care about the upside. They focus on protecting their downside, on how to minimize the drawdown, because that is what hurts you and kills you. in this business, both in terms of your capital loss as well as loss of confidence.
And this is why, if you know, I was on the institutional side for a little while, and this is how endowments and pension plans and foundations manage their money. They're never worried about maximizing returns in a bull market. They're worried about protecting or minimizing losses in a bear market. You know, otherwise they're doing a disservice to their, you know, their pension plan members or you know, endowment recipients and whatnot. So. Okay, well, we'll end it there. Thank you so much, guys. Really appreciate your time today. We'll have to do this again sometime soon. I know we didn't get a chance to do a lot of questions here, but you know, maybe next time we'll take some Q&A. There was just too much coming in too quickly. I couldn't even pay attention to the chat. So thank you, guys. Appreciate it.
Really enjoyed it.
Great to chat with you guys.
Yeah, good to see you finally in person.
Yeah, awesome. Love connecting with you guys.
I'll see you guys on Twitter.
Thanks for setting this up, Jonah.
Okay, cheers.
Bye, guys.